Hello everyone, right now is March 23rd, 2019, Saturday in the afternoon here in New York City. So this week, few important events happened in the markets. First of all, on Wednesday, the Fed announced that there will be no more rate hike for the rest of the year, for the rest of 2019. And then on Thursday, which is the day after the Fed announcement, the market went up dramatically. And on Friday, for the first time since October 2008, there's a yield curve inversion, meaning the 2-year US Treasury yields is now higher than the 10-year Treasury yields. As a result, the market dropped sharply. So now question on everybody's mind is, where is the market going to go next? And also, what's really going on in the US economy and the stock market in general. So in this video, we are going to talk about the bull's case and the bear's case for the upcoming economic conditions. Okay, so let's get started. So right away, let's go over the bear's case. Okay, obviously bears are the people who think the market is going to go down. Okay, the bear case is that number one, the economy is still very weak in the Eurozone. Okay, in Europe, like EU and stuff like that. For example, Italy just went back into recession a few weeks ago. And the economic figures out of Germany are rather weak. If you look at industrial numbers or other economic figures, the growth is very, very little, almost borderline recessionary. So if you're not careful, if you just get a very few bad numbers or very little margin for error, Germany might consider going to technical recession. And on top of it, a little while ago, the European Central Bank announced that they will persist on its zero interest rate policy, or NIRP, NIRP, for the foreseeable future. That is negative. Why? What is negative interest rate policy? Everyone knows if you lend money to somebody, okay, or you deposit money to the bank, you're supposed to get interest rate. But under the negative interest rate policy, instead of getting money back, you are actually paying the bank money to deposit money in the bank. Or when you borrow money from somebody else, instead of paying people interest, negative interest rate, that means somebody actually paying you money to ask you to borrow money. Okay? So why do we have negative interest rate policy? This is an extreme form of monetary stimulus. We have our QE and Europe have their NIRP. So what that means is that economy is so weak. Okay, and one way to stimulate economy is by asking people to borrow money. And because people don't want to borrow money, what's going on right now is that they cut the interest rate to negative. They are giving people money, begging people to borrow money from them. So is this a sign of a strong economy or a weak economy? Obviously, it's a weak economy. And on top of it, the European Central Bank has been maintaining this policy for quite a while now. And the latest announcement from the European Central Bank is saying that they're going to maintain this kind of policy for the foreseeable future. So what that's telling us is right now that European Central Bank do not see a strong recovery in the Eurozone. Okay, now number two, the Japanese economy still have not recovered and is still very weak. As we all know, for the past about 30 years now, since 1989, okay, starting 1989, the Japanese economy has been in a great recession of its own. It hasn't really been growing, but it hasn't collapsed. It's basically just stuck there. And the latest economic figures has shown that it's not really growing. Every time you'll grow a little bit and fall right back in, and back and forth, back and forth. So the Japanese economy is still very weak. And remember, Japan is the number 3 economic entity in the world, follow US and China. Now, the Chinese economy is beginning to slow down as well. Okay, the latest figures from China showing that its economy is slowing down. Why is this an important factor? Because for the past few years, when the rest of the world has been slowing down, China is actually the growth engine of world economy, because Chinese economy has been developing, and its appetite for resources around the world, it's being tremendous. And in fact, some would even argue that for the past few years, the Chinese economy is the singular pillar that's holding up the entire global economy. And now, because they've been developing very strong for the past 40 years, now the cycle is coming to an end and the economy is slowing down. On top of that, we have trade war between the US and China, and a lot of geopolitical tensions, because China and the US is number one, number two economic entities in the world. They have a lot of disagreements throughout many issues, from 5G to the Belt and the Road and various geopolitical South China Sea, so on and so forth. And all these cannot bode well for the global economy. So as a result of 1, 2, 3, Eurozone is not doing well. Japanese economy is not doing well. China is now slowing down. The US seems to be the only island of prosperity remain. However, here are the concerns. Number one, our current economic cycle is nearing an end. We've been expanding for quite a while now, and the various figures that just been released lately showing that the growth rate has been slowing down now. So you can see that the slowing down is actually happening now. And also, the stimulus effect from President Trump's tax cut, according to many experts, it's now over. Because before they kind of describe it as a sugar rush, because we had this tax cut, so they put a lot of stimulus into the economy. And now, it's been over a year, almost 2 years now, that sugar rush is over now. The rush is wearing off. Okay? And number three, for the past 10 plus years, we have been in the longest economic recovery and the bull market. I'm sorry, that should be a bull market lasting, and this thing should be over now. Over soon, because the bull market, in some respect, people are saying that it's the longest bull market in history. And we all know nothing lasts forever, nothing goes up forever. So that should be over soon now. And number four, ever since President Trump's election, there has been a lot of domestic political infighting between the Democrats and the Republicans and various factions of the US political scenes. And we all know what this does is that it creates a lot of uncertainty and amplified volatilities. For example, just this past Friday, after the market closed, okay, the Mueller's report on the Russian collusion has been delivered to the Justice Department. And so far, we are all awaiting what the Justice Department is going to do. And already, the Democrats and the Republicans are gearing up for a fight. And what this creates is that it's a gridlock. And it's not a good kind of gridlock. Okay, a lot of things that should get done in the US, for example, infrastructure, a whole bunch of other physical policies are not getting done. Okay, so at the very best, this creates type of paralyzing gridlock for the US economy and the US in general. And at the worst, this could have a lot of spillover effect to many other aspects, of the US economy. Okay, and number five, the Fed has announced that there's no more rate hike for the rest of the year of 2019. So what that means is that we all know the Fed has been hiking rate for quite a while now, for the past couple years. In fact, the reason that the US stock market has dropped dramatically the end of last year, especially December, is many people believe that the Fed has raised the rate too much, to the point that it's actually hurting the US economy. Okay, and why would you want to raise rates? You only raise rates when you think the economy is doing very well, right? It's burning hot. You want to head off inflation. And why would you want to stop raising rate? If the US economy is still doing well, why would you ever stop? So by the Fed not raising the interest rate anymore, they announced that for the rest of 2019, we are only at March here. So there's still 9 more months of the year to go. So in other words, the Fed could already foresee for the next 9 months, the economic situation is no longer going to be growing a lot. Therefore, it could, it doesn't need to raise rates anymore. So that cannot be good news for the economic growth in general. Okay? And also possibly signaling a pending slowdown in the US economy. Now, number 6, this is the news that just came out last Friday. The US Treasury Yield Curve, okay, and the yields actually inverted for the first time since October 2008. For the first time since in 10 years. And that's generally interpreted as a sign of a pending recession. Now, let me explain what that means by yield curve inversion. First of all, US Treasuries are the debt instruments issued by the US government. That's basically the IOU from the US government. US government needs to borrow money, okay, in order to keep its functions. We have a lot of bills to pay, and we don't always have bring enough tax revenues. So as a result, the U.S. government have to issue these IOUs, and we call them treasuries. When they're long-term, we call them treasuries to borrow money. Now, these treasuries, different treasuries, they have different expiration dates. In other words, some you can lend money to the U.S. government, sometimes for long-term, some as long as 30 years, some are 10 years, some are 2 years, some are as short as a few months. Okay, when they are less than 1 year, we call them bills. Between when the longer term, we call them notes, and when they're longer, we call them So anyway, the most widely watched are the 2 years treasuries, 2-year notes, and the 10-year notes. Okay, so these are the U.S. IOU, government IOUs that come due in 2 years and 10 years. Okay, now when you borrow money, when you ask to borrow money from people, you want to pay them interest. Usually, the longer the expiration date, the longer that you're borrowing the money, you're going to demand a higher interest rate, right? Why? It's very simple. Because when you lend somebody money for a longer period of time, there's more uncertainty, right? The longer the time spent is, there are more uncertainties out there. So therefore, you're gonna want to demand for more money to compensate for your additional risk. And when you borrow money for a shorter term, obviously you pay less interest rate. If for those of you who have mortgage in your house, this could you can easily verify this fact for yourself. When you go to a bank, try to take out mortgage, you can easily see that the 10-year mortgage rate versus, let's say, a 20-year, 30-year loan is got to be much less, because anytime you borrow less, the bank will charge you less in terms of interest. Okay, so that's just common sense. Now, on Friday, for the first time since October 2008, the yield, in other words, the interest demanded for the 2 years rate, 2 years treasury notes are actually higher than 10 years. What that means is that the investors in the bond market saying that, okay, Uncle Sam, I'm going to lend you money for 2 years, but now I actually want more interest. I want more money from you for only lending you money for 2 years instead of for 10 years. Why is that? That is saying that, you know what? I am not as confident on the U.S. market, on the U.S. government, U.S. economy for the next 2 years as I would for the next 10 years. That is very counterintuitive. Think about that. Okay? 10 years, we all know, U.S. economy, as big as we are, and our great history, market history, everybody can look it up. Over the long run, U.S. economy in general, okay, overwhelmingly, it's been going up. So no matter what kind of recessions or economic problem we have, over the long run, we sort itself out and it gets better. Okay? But on Friday, all of a sudden, investors are saying that, you know what? For the next 2 years, I am not so sure. I'm not so confident about the relative performance of the U.S. economy for the next 2 years. So I'm going to demand more interest, more money from you to lend you money. Okay, so that's a bad sign. So that's why on Friday, the big market drop was attributed to this. It's the first time since October 2008 that the yield curve flashed, inverted. Okay, for the first time. So to sum up, the bear case is this. Very simply put, the global economic situations remain dire. Now, how long could the U.S. remain strong? And there are already many signs showing that the weakness is growing. Or in fact, some other people even argue that it's confirming the U.S. is now heading toward a recession. Okay, that's the bear case. Now, as we all know, there's always two sides to a market. For every loan, for every time there's somebody buy, somebody sell. So if there's a bear market, it's got to be a bull market. Okay. Now here's the bull case. The bull case is saying that number one, the Eurozone economy is slowly recovering, and it's better to be slow and steady than hot and fast, right? Yes, the Eurozone economy, European economy, even though it hasn't been growing very fast, but it's been slowing recovery for quite a while now, and it's the best kind of recovery because it's slow and steady, because you don't want to have like what US, the overheating economy. That's the whole reason why the Fed had to raise interest rate in the first place, because US economy was growing too hot and too fast. And when you get too hot and too fast, you're going to have inflation or into a bubble or overheating economy, all of which is not good. So what European economy is doing right now is actually slow and steady. Okay, it's kind of like, your Goldilocks. Okay, not too hot, not too cold, just right. And that's exactly what you want. Okay, and number two, the Chinese government, knowing that the economy is slowing down, Okay, all the news, all the indication out of the Chinese government is that they are embarking on a massive economic stimulus plan, try to revive the Chinese economy. And many experts will even go as far as saying that the Chinese government is pretty much throwing in the kitchen sink. They're trying everything and anything, try to save its economy. And if you look at the Chinese government, it's a different political system than we are. They have a authoritarian and communist in name only, but the government has a lot of authority, a lot of power. And the government is a big percentage, big factor in its economy. So when the government is committed to do something with the economy, if you look at the past 40 years, they usually succeed and succeed spectacularly. So we have no reason to doubt that this time the Chinese economy would not also recover very well. That's the both case. Now, number 3, if you right now you say, okay, yes, the Fed won't hike interest rate anymore for for the rest of 2019. That's actually a good thing, because if you think back in December last year, 2018, why did the market drop so much? The reason that the market dropped so much last year was because everybody thought the Fed was so dogmatic. The Fed was stubborn and kept on raising interest rate without acknowledging the the reality in the US economy. Okay, so basically, the reason that the market was dropping so much was because the market was saying that the Fed was raising interest rate for raising interest rate's sake. Okay, they were not on the side of investors. In fact, they were actually working against the investors, stock market investors. That's why the market dropped so much. Now, our Fed chairman, Jerome Powell, Chairman Powell finally learned its lesson. It's now back on the side of equity investors. So basically, the Fed put is back again. The Fed has got investors back now. So we can all be happy and everything like that. Okay? Now, number 4, as far as the yield curve inversion, the signal that it's a possible recession. If you look at all the authoritative and the credible studies out there, whether academic or done by industry, in order for this inversion indicator to be valid, you need at least 1/4 of inversion. Okay? Right now, we just have our first day of inversion, 1 day, Friday only. 1 day does not a trend make. You need to have at least 1/4, 3 months, a consistent, okay, in order for that signal to be valid. And the temporary inversion, this temporary inversion is 1 day or even a few weeks inversion is actually great. It's actually the market's a self-correcting mechanism. Because if you think about it, why did the Fed want to raise interest rate in the first place? The Fed was worrying that the economy might be overheating. Okay, thus creating inflation, overheating economy, creating a bubble, all that nasty stuff. So you want the interest to be, so by raising the interest rate higher, you try to cool the economy down a little bit. And we all know the last December, the reason the market dropped, so big was because, the market thought the Fed overdid it. Okay, therefore the market, and also we also know that in the US, we had a strong belief that the best way to correct any market assets is through the market itself, through the free market itself. Let the free market, write itself out. So the fact that the short-term rate interest rate is actually temporarily higher, that's the market its self-correcting mechanism. We don't need a Fed to overcorrect. We don't need a Fed to use this blunt instrument. Okay, because the Fed cannot act that fast. The market could do it better. The market could do a better job. So this is actually a sign of a healthy, free functioning market. So the fact that the yield is actually higher, this is great, because it can, if the yield can go higher, it cool down the market a little bit. We don't need the Fed to come here, do these government intervention and overdid it and stuff like that. So this is, to them, this is actually a great thing. Now, number 5, perhaps the most important reason in their entire arsenal for the bull's case. Let's call it the Great Recession of 2008. Okay, we all know what happened 10 years ago. It was, whatever you want to call it. Okay, some thought that, something that we're still in this economic, the Great Recession. It's the worst economic crisis since the Great Depression of 1930s. Okay, in fact, many people will tell you that it is a Great Depression number 2. We just call it Great Recession to make it sound better, to sound less scary. Because now if you look at a lot of research, a lot of documentary, a lot of records out, the world economy in general, in fact, was so close to collapsing back in the days. Okay, we were that close to the entire system collapse. Okay, so the last 10 years of this growth It's only the initial stage of a multi-decade long healing and then later on expansion process. If you look at it, a very, very long-term trend. See, a lot of times bears like to talk about long-term cycles. Well, the bulls can also talk about the long-term cycles. If you talk about the cycles that lasting 70 years, 100 years, what have you. Okay? The last cycle that we have was from the 1930s. Right? That's the last Great Depression. And it kind of righted itself, in the wake of World War II. After World War II, because World War II created a lot of demand, World War II ended, and it was a huge expansion from post-war era until 2007, the bubble burst. And that gave us the Great Recession. That's a one cycle. So that whole cycle lasted about, if you count from 1945 to 2007, it lasted 62 years. Okay? That's one credit cycle, or whatever you want to call it, or the long-term economic cycle. So right now, according to bulls, we are in another huge multi-decade recovering phase. What is 10 years in the grand scheme of this 60 plus multi-decade cycle? It's nothing. In fact, this is only the very beginning stage of healing. So we cannot call this a bubble. Okay? This bull market, it's not even really a bull market. We are just getting back what we lost before. We are just beginning to being made whole. And in fact, as mentioned before, the Eurozone and the Japanese economy, are still not quite fully recovered yet. They are actually, US is kind of recovered okay now. Okay, according to the Fed, according to a lot of experts, and the Eurozone and the Japanese economy are just started climbing out of, their healing process. So we can expect a few more decades, okay, not years, of synchronized global recovery and expansion, like the one we experienced from 1945 to 2007. Okay, that's a 62. So that is 62 years. So that's the bulls case. So in summary, the bulls will tell you, bubbles burst in euphoria. Just look at 2007 and 2001. 2000. Back in 2000, everybody's a stock trader. Everybody's a day trader. Everybody's participated in buying NASDAQ.com stocks. Okay? And back in 2007, everybody and his mother is a real estate investor. Okay? And both began in a sea of worries. But look at right now. Are we really in the bubble? Are the participation rate among the retail traders, investors very great in the stock market? In fact, it's not. If you look at the financial news, a lot of people are actually worried that we might be slipped back into the Great Recession, or the Great Recession has never really ended at all. So the bull's arguments that, in a sea of worries, forget about the bull market climbed the wall of worries. Forget about the wall of worries. We are right now still drowned in a sea of worries. And in fact, that's usually the beginning of a great bull market. So that's the bull's case. Okay? So right now I just presented to you, right or wrong, I'm not taking sides here, bear's case for why the stock market economy is going to suck. Okay? And the bull's case why this is actually the beginning of another great prosperity time ahead. Okay? So, and this all related to what happened last week. But what I give you right now, this is a very global, macro, very long-term view. As investors and as traders, we have to somehow quantify these, somehow turn these into numbers. Right now, these are great reasons, but how do they really help us, really, in terms of actual numbers, actual investment? Okay, so right now, we are looking at these charts. This is my Pendragon 3-2-1 trading system. 3 lines, the green line, pink line, and the purple lines, and 2 sets of trading signals and 1 indicators. Okay, right now you're looking at SPY. That's the S&P 500 ETF. The chart all the way on the right, M stands for monthly. The one in the middle, W, stands for weekly. And the one on the left, D, stands for daily charts. And the numbers to the right, these are the numbers for these lines. Okay, I just labeled them out. These are power lines, as I call them. You can think of them as moving averages, but they are better than moving averages because they can also help us forecast possible pressure points, which I call actually the price points where it could be potential support or resistance. So right now, right away on your monthly chart, point A right here, as mentioned in the previous video, starting in February, okay, started last month. Although the argument I presented to you before, the bears are looking for a market collapse lasting a few years. Okay, and the bulls are looking at multi-decade, super bull market or super period of economic expansion. I'm not looking that long. I'm looking at monthly chart. You look at my previous video, I talk about could this be a quiet bull market starting. We are looking for the next few years, so at least according to this right now. Okay, in order for there to be a real market collapse, the market have to drop below the purple line right here on the monthly chart, which is 232.08, this level. And as you can see, even with the Friday's drop, Friday we closed at 279.25. We are still quite far away from there. Okay, so that's where we're coming from. And if we on the weekly chart, there was a pink dot. That's a confirmed short signal, but because market went up, it took out a high previously. So now this short signal has now been null and void, has been canceled out. Okay, so and now on the daily chart, let me label this out. On Friday, we closed at 279.25. The potential support is actually at 278.82. It didn't quite reach there. Okay, so what can we do here? Here I'm going to introduce you to a product. It's called SVXY. SVXY is a VIX Volatility Index ETF. Most of the time, it moves this direction. It's in sync with the way that S&P is moving, SPY is moving. So if you look at SPY before, it did not really give us a very easy way to decipher where it wants to go. But if we look at SVXY, then we can have a better sense where it's going. In other words, when SPY, the S&P 500 ETF was dropping, SVXY usually will be dropping as well. Okay, because they are correlated. SVXY, it's a volatility ETF. It's actually based on the VIX futures, which is based on the VIX, which is the put options, implied volatility and whole sorts of things. We're not going to go into detail here. For those who are interested, please look it up on the internet or something. You can, well, maybe one day I'll do another video specially dedicated to explain this. But for now, we just take my word for it. SVXY price movement, they are highly correlated to SPY. Okay, so now on Friday, okay, let me blow up this chart right here. Now we're looking at daily chart, SVXY. First of all, you'll notice this purple line right here. For the past few days, SVXY has been supported by the purple line right there. Okay, but on Friday morning, the moment it opened below the purple line. Okay, and then it started going down. So the first target is this green line right here. And in fact, if you check your daily chart, I have a number label right here. If you later on you want to do your own work, you can pull up like minute charts. When you reached 51.36, so there, give or take, the market did pause for a little while. Okay, even bounced for a little bit, and before its subsequent drop. And when it dropped to a 50.55 and below. That's a support. So as of Friday, it closed at 50.03, below the 50.55 level. That's where SVXY closed. Now, why is that significant? If you look at it on the weekly chart, which is the middle chart right here, there is another support line being labeled out, 50.17. So 50.17, 50.55, the two lines, the value are very close. They in fact converge into the same price levels. So that means is that this is actually a very strong support level. Okay. When we look at Pendragon 321, the three lines, first thing we gotta look for is this: is the current trading price above or below all three lines? Okay, let me repeat that again. Is the current stock price above or below the all three lines? If the current trading price of this product, the stock, ETF, what have you, is above the three lines, then there's a very, there's a good chance that a strong up move can start here. Because it's not always, it's not a guarantee, but a lot of time if you examine, usually big moves started when the price is above the three lines. That makes sense because when the price is above the three lines, that means there's no more resistance lines above it. Okay, so the stock can really take off from that moment on. Conversely, if now the stock price is trading below the three lines, there are no more support lines below it, then if the stock really wants to drop, big, huge drops can start from there. In fact, let's look at SVXY. The last few times it go below the 3 lines. So right here, everybody see that? SVXY traded below the 3 lines. And we had this huge drop. This, in fact, is actually the beginning of the December drop last year. The December last year drop, okay? You know, that was the worst drop in 87 years. And then we have a small drop right here. Right? Everybody see that? And then, another time, this is actually the beginning when the market actually went below the all 3 lines. This is the beginning of the first down move. And when did this happen? This happened back in October 2018. Okay, so now why we have to watch out now? Right now, as of Friday, the SVXY actually closed below all 3 lines. Okay, even though if you look at SPY, it didn't even touch the first correction level. It didn't even touch the first support level, right? If you look at from weekly chart and the monthly chart, it hardly make any dent. But SVXY is telling us that, giving us this warning sign. Okay, everybody see that? On the monthly chart, it's hardly make a dent. On the weekly chart, it's really nothing. And on the daily chart, it didn't even touch 278.82. But SVXY is flashing us a very strong warning sign. It's telling us how to watch out. If you drop below, you know, if you continue to go down next week and go below that, there's a possibility that a new wave of downtrend will start. Okay, we're not going to see that from SPY, not yet anyway. But here's another counterpoint though. Right here, we have this green dot right here. This is the alert for my trend GPS trading system. It's 2 sets of this trading system and the 3 lines. They're using different mathematics. They're using different formula and different algorithms. But they sometimes they complement each other. Sometimes they come to the same conclusion. Right now, by having this green alert signal, okay, it's alert. It's not a confirmed signal. It's telling you that this could be a good level to go long. If the market bounce from here, in other words, the market could be, you know, it's ready for a bounce now. Any price level around here is a good price level to, you know, for the market to bounce. Okay, the market could bounce here. Okay, look what happened before here. Just about a week or 2 ago, right here. Let me label a point B. The market bounced, right? So here, once again, we reach this level right here. So therefore, we know we have reached a very critical level. Either we drop and start, you know, according to SVXY, maybe another new significant downtrend in SPY, or we bounce from here. So that's the thing we gotta watch out for. Now, if we do, you know, start going down, so the numbers you want to watch out for, well, obviously the very first one is 278.82, the next one is 275.72, and then 269.02. This is on the daily chart, okay? And these are the other numbers on the weekly chart and on the monthly chart. So a lot of time, I know right now this is on my own proprietary trading system. I'm not selling this. I'm just sharing with you guys right now. And how are you going to use this? It's actually very simple. What you can do is that you can pause the video, look at these numbers, okay? Then go to your own charting software. You draw lines on these numbers, okay? You can even just, let's say, using a daily chart, okay? You just draw parallel lines, okay? And you just write out, you know, you just label all these numbers and watch how the price react when they reach those price in real time. Okay, that's what you can do to use these lines. So in fact, you don't really need my system. You can just the moment you have a thing, you just like what I'm trying to do here. 278.82. Well, let me go to more precise here. Okay, so you draw out these lines. So once I draw that, let me for now, because I'm showing to you guys, I can get rid of that. So you draw these various lines right here. You know, you label all the numbers, and then you even draw the lines. Let's say 274.61. You can draw it here. You can draw the weekly chart, all on the same charts. Then you will be amazed how well these things work. Okay, when the market reaches all these numbers. Okay, so you draw all these out and you just watch them in real time, see how they unfold. And if you want, you can even use intraday charts, like 15 minutes or something, and see how these things work. Okay, so right now, so this basically concludes this video, and I would like to know what you how you like it, and please leave me some comments, and or you can either leave it on this video, or you can email me. My email address is right here. It's panlong321@outlook.com. So also, I would like you guys to do me a favor. So in this video, the first part, I talk a lot about fundamental analysis. I give you the bull case and the bear case for where the market might go. On the second part of this video, we go into more about the technical analysis, analyzing how the market is going to go. So I'm curious, which part you guys like better? Okay, would you like me to talk about more about in the fundamental sense what the market is going, or more go into the technical analysis aspect of it? All right, please let me know, and I will see you in the next video. Thank you, and I will see you soon. Take care. Bye bye.